Good morning, good afternoon, and good evening, ladies and gentlemen. Thank you for joining me here today. You know the saying, don't work for your money, make it work for you. Now, Swanee Trading and GSI Markets have put together how to maintain a profitable trading career. Now, this is an educational webinar that's designed to give any type of an audience a better understanding on potential areas of investment within the Forex industry. Now, for those of you that have never joined me, the way I conduct my webinars is very simple. I always start with an introduction, who I am, a general overview of what the webinar is essentially about and what you should really gain from it, and overviewing the content. So the topics that I'll be covering are what is Forex, the history of Forex, so what is Forex trading, the spot market and the forwards and future markets, what is the spot market, what are the forward and future markets, the history of the Forex market, the history of Forex market in a bit more in-depth detail, Bretton Woods system, and I will continue with why trade Forex, who trades Forex, 8 reasons to really consider currency trading. So market size, ease of entry, profit potential, tax advantages, trading hours, no commissions, increased leverages, guaranteed stops, and what is Forex essentially. Now, who should trade Forex? Now, there are many players in the Forex market that you need to know about and essentially how they make the markets move. Forex traders shape businesses. Let's trade live now. I'm going to conclude with that. If you have any questions, and at the end, well, if you have any questions, leave them to the end, and I appreciate that. So what we'll do in this session is we'll go through these topics, and we'll get a chance to jump on to a few trades, plus 2 trades that I essentially bought about 40 minutes ago, which are the same positions except one is a sell and one is a buy, and I'm going to explain the reasoning for that and why the outcome is as it is. Okay, well, thank you, ladies and gentlemen. I'm going to start with the introduction. So who am I is the question that most of you may be asking. Well, I'm an expert energy and financial market analyst. I've got over 10 years of experience servicing the financial and oil and gas industry, including the telecom sector. Now, I am known as quite an extraordinary individual with fantastic and extensive experience working at government and corporate level. I provided my expertise in market analysis reports and go-to-market strategies. Now, I am also quite a well-traveled professional with great exposure to a diversity of cultures. Now, this has given me a market edge on being on top of my game, particularly within emerging markets and more specific West Africa on the whole. So I have prepared numerous research reports for private and corporate clients across Africa and the UK, parts of Europe. And I've also managed several different types of business operations from more around business development operations, from startup incubation companies all the way through to existing business models where I've value added to their go-to-market strategies, as well as their sales capabilities. So that's a little bit about myself. Now, what we're going to be learning in this webinar is very simply, what is Forex trading, so how it works, what it is, how it's incubated, how it's, formed itself, where it's diversified over the years or over the decade, and how it's become more of a retail market. So we'll go through the essentials of Forex trading, the history of Forex trading, where it actually formed from, and we'll look at many reasons why you should actually consider currency trading and how it can be quite a profitable additional income to your daily activities. Now, we'll also look at who actually trades Forex so you understand how the market works, and go into a little bit more detail on what is Forex. Now, once we've concluded that, ladies and gentlemen, you're going to see a couple of live trades. What I want to do with this live session that I'm going to educate you guys on is we're going to look at one technical indicator and how useful it is, how it works, how you can essentially catch the market in order to create some profit and some wealth for yourselves. But of course, remember, it is the financial industry and there's always a risk element involved. But with high risk, there's always a high reward. So let's start with what is Forex trading? Well, what is Forex trading and the history of Forex trading? Well, you know, the foreign exchange market is actually a place where currencies are traded, and currencies are important to most people around the world, whether you realize it or not, or if anyone else realizes it or not. So this is because, you know, currencies are actually needed to be exchanged in order to conduct foreign trade and business. So if you're living, let's say, in the US, for example, and you want to buy, I don't know, some cheese, some bread, from France, maybe you want a baguette, or you want some of their lovely cheese that they have over there. Either you're a company that that you tend to buy cheese from various different places, and you have to pay the local provider that's providing the product in their local currency. So this means that a U.S. importer would have to exchange the equivalent value of the US dollar into euros or any other currency depending where you're buying your goods from. Now this same actually goes for traveling. So again, another example is a French tourist in I don't know, let's say Saudi Arabia, let's say Egypt, let's say Egypt, can't really pay in euros to see the pyramids, and that's because it's local. Well, it's not locally accepted in terms of the currency that you're trying to utilize. So as such, the tourists have to exchange their euros into a local currency, and in this case, the Egyptian pound. So the current exchange rate of that day, that second, would be exchanged for the amount of euros you have in order for you to have some local currency to be able to shop around, or of course go and do some sightseeing, or whatever it may be. So the need for exchange in currencies is the primary reason why the Forex market is one of the largest, most liquid financial markets in the world. And it really does dwarf other markets in terms of its size, even the stock market. So the stock market actually trades with an average of around $2 billion plus per day. And the total volumes, change all the time. But in respect to the statistics that I'm giving you, and I believe the statistics that you probably Google and find out for yourself, is that the Bank for International Settlements, the BIS, actually reported that the Forex market trades in excess of 5.3 trillion per day. So you can see how much it really does dwarf the rest of the markets, because it's such a giant in terms of the amount of traders that are online now, having access to virtual markets and trading every day. So one of the unique aspects of this international market is that there are no central marketplaces for foreign exchange, rather than currency trading on conducted electronically over the counter, so OTC, for example, but in virtual markets, and which means that all of these transactions actually occur via computer networks between traders around the world, rather than one centralized exchange. So the markets is open 24 hours a day, 5.5 days a week, and currencies are traded worldwide in major financial centers such as London, Tokyo, New York, Hong Kong, Frankfurt, Zurich, Sydney, Paris, Singapore, almost across every different time zone. So this means that when the trading day in the US ends, the Forex market begins in a new time zone, for example, Tokyo and Hong Kong. So as such, the Forex market can actually be extremely active any time of the day, with price quotes changing constantly. Now, let's look at the spot market and future markets. Well, there are actually three ways that institutions, three ways that institutions, corporations, and individuals trade Forex. So the spot market and forwards market and the futures market are essentially together within their own virtual territories. So the Forex market trading in the spot market always has been the largest market because it's the underlying real assets that the forwards and futures markets are actually based on. Now, in the past, the futures markets was the most popular venue for traders, and that's because it always had available to, well, I mean, it's always been available to individual investors for a longer period of time. However, with the advent of electronic trading, the spot market has actually witnessed a huge surge in activity and now surpasses the futures market as the preferred trading market for individual investors and speculators. So when people actually refer to the Forex market, they usually are referring to the spot market. The forwards and future markets tend to be more popular with companies that actually need to hedge their foreign exchange risks out to a specific dates in the future. So it works totally different. A lot of people wonder what the spot market actually is. Well, let's be more specific here. The spot market is where currencies are actually bought and sold according to the current price. That the price is determined by supply and demand factors and is in relation to many things, including current interest rates, economic performance, sentiments towards ongoing political situations, so geopolitical issues, i.e., both locally and internationally, as well as perception of the future performance of one currency against another. When a deal is actually finalized, this is known as a spot deal. It is a bilateral transaction by which one party delivers an agreed upon a currency amount to the counterparty and actually receives a specific amount of another currency at an agreed upon exchange rate, of course. So after a position is closed, the settlement is in cash, although the spot market is commonly known as one of the one that actually deals with transactions in the present rather than the future. So these trades actually take 2 days for settlements. It's again a little different in comparison to the FX market as well. But let's look at what the forwards and futures markets are like. Well, unlike the spot market, the forwards and futures market do not trade actual currencies. Instead, they actually deal in contracts that represent claims to a certain currency type and a specific price per unit, and of course a future date of settlement. So in the forwards market, contracts are actually bought and sold OTC, over the counter, between two parties who actually determine the terms of agreement between themselves. Now, in the futures market, the future contracts are bought and sold based upon a standard size and settlement date on a public commodities market, such as the Chicago Mercantile Exchange. Now, in the U.S., the National Futures Association actually regulates the futures market, and the future contracts have specific details, including a number of units being traded, delivery and settlement dates. Pardon me. With a minimum price of increments that cannot be, customized. So the exchange acts as a counterpart to the trader providing clearance and settlement. So both types of contracts are binding and are typically settled for cash for the exchange in question upon expiry. Now, although contracts can actually also be bought and sold before they expire, the forwards and futures markets can actually offer protection against risks when trading currencies, usually being big international corporations that use these markets actually to, as I mentioned before, it's really in order for them to hedge against future exchange rates and fluctuations. But speculators actually take part in these markets as well. So now that we understand what Forex trading is and its various different virtual counterparts, let's look at the history of Forex. Now, we've learned, quite a bit thus far, and it's really almost time to start trading, of course, ladies and gentlemen, once we finish these last couple of topics. But you have to look at the given the global nature of the Forex market itself, and it's very important that to really examine and learn some of the most important historical events relating to currencies and currency exchange. And in this webinar, we'll actually take a look at the international monetary system and how it has actually evolved to its current state. So, what we'll look at is the major players, once we've covered how the monetary system had actually formed, that occupy the Forex market, and something that is essentially important for all potential Forex traders to really understand. As I mentioned at the beginning, we have to know who moves the market in order to not necessarily copy trade, but to essentially move with the market rather than go against the market and lose based on that reasoning. So let's look at the history of Forex. So the history of Forex is based around the gold standard system, and the creation of gold standard monetary system in 1875 is one of the most important events in the history of the Forex market. So before the gold standard was actually created, countries would commonly use gold and silver as a method of international payment. And the main issue with using gold and silver for payment is that the value of these metals is greatly affected by global supply and demand factors. So for example, the discovery of a new gold mine would drive gold prices down, all right? Meaning that there is so much supply in the market that the product that you're trying to sell essentially devalues itself due to not having enough demand in the market to take that extra supply. So, when you look at the discovery of a new gold mine and prices dropping, or whatever type of commodity, it doesn't have to be that. You can take that method and utilize it in anything. If you understand economics, this is basic economics, ladies and gentlemen. Now, the basic idea behind the gold standard was that, governments actually guaranteed the conversion of currency into a specific amount of gold and vice versa. And in other words, a currency was backed by gold. So obviously governments needed a fairly substantial gold reserve in order to meet the demand for currency exchange during the late 19th century, although all the major economic countries had actually pledged an amount of currency to an ounce of gold. And over time, the difference in price of an ounce of gold between two currencies actually became the exchange rate for those two currencies. So this actually represented the first official means of currency exchange in history in terms of how to value a currency. So the gold standard eventually broke down during the beginning of World War I, and this was due to political tension with Germany, and the major European powers actually felt a need to complete large military projects so that they could begin printing more money to really help pay for these types of projects. So for me, that's devaluation of currency. That's oversupply of paper notes with no real backing or hard commodity behind it. So i.e. the gold actually backed that currency, and because of the amount of gold that a certain country had in its reserve, based on the amount of paper that was printed, would devalue, creating inflation in those countries. And that's what we saw with the Great Depression during the World War periods, World War I and II, where economies really felt a lot of tension towards its own economic system. So when you have countries that are printing to be able to, cover their financial burdens of these projects was so substantial that, there was not enough gold at the time to exchange for all of this extra currency that governments were printing off. Although the gold standard would make small comebacks during the years between the wars, but most countries had actually dropped it again by, the onset of WW2, World War II. But however, gold never stopped being the ultimate form of monetary value. Now, once that happened, you had we looked at the Bretton Woods system is what which before the end of World War II, the Allied nations actually felt the need to set up a monetary system in order to fill the void that was left when the gold standard system was abandoned. So in 1944, July, more than 700 representatives from the Allies actually met in Bretton Woods, New Hampshire, to really deliberate over what would be called the Bretton Woods system of international monetary management. So, to simplify it, Bretton Woods led to the formation of the following. The US dollar replacing the gold standard to become the primary reserve currency, a method of fixed exchange rates, and the creation of 3 international agencies to oversee economic activities such as the International Monetary Fund, the IMF, which we're all accustomed to today, the International Bank for Reconstruction and Development, and the General Agreements on Tariffs and Trade, GATT. But the main feature of Bretton Woods was that, the US dollar replaced gold as the main standard of convertibility for the world's currencies. But furthermore, the US dollar actually became the only currency in the world that, had and would be backed by gold. So this turned out to be the primary reason why Bretton Woods system eventually actually failed. Now, over the next 25 years or so, the system ran into a number of problems. By the early 70s, the U.S. gold reserve was so low that the U.S. Treasury did not even have enough gold to really cover all the U.S. dollars that foreign central banks had in reserve. But look, finally, what happened was in 1971, I believe it was August 15th, the U.S. president, who was Mr. Nixon, Richard Nixon at the time, actually closed the gold window, essentially refusing to exchange U.S. dollars for gold. This event actually marked the end of the Bretton Woods, and even though the Bretton Woods didn't last, it left an important legacy that still has a significant effect today. And this legacy exists in the form of 3 international agencies created in the 1940s. As I mentioned earlier on, the IMF, the International Monetary Fund, the International Bank for Reconstruction and Development, which is now a part of World Bank, which we're all, again, accustomed to and know quite well, and the General Agreements on Tariffs and Trades, which led to the World Trade Organization. Now, I'm glad we covered the history of Forex. Now let's look at why trade Forex and who actually trades Forex. Well, there are 8 reasons to actually consider trading Forex. And, with the big slide in the US dollar since, the early 2000, 2002 to be more specific, had actually opened the eyes of many investors to global currency markets. Trading in these markets is a round-the-clock affair with a market always opening somewhere. So, i.e., it became available for everyone. It's there for you. you know, why let all the big institutions make all the massive profits that they've been making and are accustomed to by themselves? So now that, you know, we have a virtual system that is now available to the retail market, it's worth considering for investors to actually consider currency trading. So I'm going to go through 8 different advantages for these markets, and, you know, how you can enjoy profiting or alternatively learning the financial markets. So one thing that you have to look at is the market size. Now, the currency market is the largest financial market in the world. As I said, the liquidity that comes from the market trades nearly 5.3 plus trillion on a daily basis, and it enables you as an investor to actually enter and exit your positions easily without having to, you know, worry about price jumping too far, you know, before you execute a trade, or having to get on the phone with the old school systems and ask your broker to, you know, close a trade for you. You can preset all of this now. Having, you know, the market size also, you know, makes it, well, the size of the market also makes it much more difficult for a single group to come in and try and manipulate the market. So hence I was saying you need to know who's in the market, which we'll cover next. Now, this means that your analysis of supply and demand will almost be likely to be more accurate. There's an ease of entry, which is the second point that you need to look at. So you can get started, you know, in the currency markets with an account opening as small as $250. So you don't really need to have a lot of money to start making you know, some sort of a great return on your actual investment. As I said earlier on, don't work for your money, let your money work for you. Okay, anyone can actually take advantage of the benefits of the currency markets, especially now being available to everyone. Retail traders such as yourselves can easily jump on the screen now, open up an account, deposit some funds, and start trading with your money. You know, if you guys already have an account with us, by all means, jump on a couple of trades that I may jump onto at the end of this webinar. If you like, you can have a look at what I'm doing and replicate the process if you like. So, you know, you've got ease of entry, you've got profit potential. So profit potential is actually what every investor actually wants to hear about, and the currency market has plenty of it. So you can make money in the currency market, whether currencies are going up or down. And if you think a currency pair is going up, all you have to do is press the buy button. And if you think a currency pair is going the opposite way down, then again, all you have to do is sell the pair. It's that easy, ladies and gentlemen. So another thing to consider is tax advantages. So currently, short-term capital gains are taxed at your, you know, current tax rate, and long-term capital gains are actually taxed at only 15%. Obviously, it is much better to pay less in your taxes. Of course, we all want to save as much money as we can. In the Forex market, it's, you know, for many investors, it's a delight. And it doesn't matter if, you know, you take your profits 1 minute after you enter a trade, or, you know, a month after you enter a trade, the first 40% of your profits are taxed at short-term capital gains rate. And the remaining 60% is taxed at long-term capital gains rate. So you have some tax incentives in this market place, allowing you to profit more than certain other investments that you may be interested in. The other thing to look at is the trading hours. Now, as I said earlier, it's open 24 hours a day, 5 and a half days a week. So, you know, whether you work during the day or you go to school at night, whatever you may be doing, it's a market where you can easily find the time to place a trade and trade currencies, basically. So, you know, another thing that you have to look at, the difference between currencies are more, you know, active at different times throughout the day. So, you know, whenever you might have the time, there's bound to be something happening, you know, with you take advantage of. When you look at the size of the market, you realize the potential momentum, the volatility, the amount of money that's being exchanged OTC over the counter, meaning it's so active that it doesn't matter what time you jump on, there is volatility, there is momentum, and that is what you'll essentially look for as well when you're trading. The other thing is you don't necessarily have the typical commissions, so you never have to pay a sales commission when you actually trade currencies. Stockbrokers, even discount stockbrokers, charge you a commission for every trade that you place, both to get in a position and get out of a position. And in the currency market, commissions don't really exist. You actually simply pay the difference between the bid and the ask price, which you pay in the stock market as well, on top of the commission that you pay in the stock market. So within the FX market, the spread is the commission that you see that most brokers put. Okay, but it is actually the spread. So it's what they charge you, as I mentioned earlier, the difference between the bid and the ask price. So another most important thing to look at is increased leverages. Now, this is perhaps the advantage that is most appealing to aggressive investors. Increased leverage allows you to really control a larger holding of currencies with very little capital or money up front. For instance, if you had, let's say, 1 to 100 leverage, you could, control $100,000 if you had $1. $1,000 in the currency market with as little as $1,000. So that means that with $1,000 you can have up to $100,000 to actually start trading. And that means that you get you get to realize all the profits on the 100,000 position while only risking a small amount of your own funds. Now, the opposite is also true. You do get to realize that all the losses on the 100,000 position too. So be aware that leverage is double-edged sword. Okay, that you shouldn't, you should use cautiously. Okay, another thing that we talked about is guaranteed stops. Now, you have the ability in the Forex market to determine at exactly which price you would actually like to enter a trade and at exactly which price you'd like to exit a trade. And these prices are actually guaranteed. A stop or a stop loss order is an order that you can place that instructs your broker to exit your trade if the price ever drops to a certain level. So, i.e., risk management, being smarter, knowing exactly what your potential losses may be for that day, or setting your profits so that you know what you want to take home and you don't get overly greedy and end up losing all your money. So these are very important. Once you learn how to set up your stop loss and exit and entry position, then you've got more risk management involved. Let's move on to what is Forex and who actually trades Forex. So as I mentioned earlier, exchange rate is a price paid for one currency in exchange for another. It is the type of exchange that drives the Forex market. The other, there are more than 100 different kinds of official currencies in the world. However, the most international Forex trades are and payments are actually made using the US dollar, yen, and euro. And of course, you have other trading instruments, including the British pound, Australian dollar, Swiss franc, Canadian dollar, and Swedish krone. There's so many currency pairs out there, ladies and gentlemen. So you just have to find what you like and what you understand about the economy, and you keep your eye on the fundamentals for the day and learn your technical analysis, which I will teach you over time as you follow me and as you follow the group that I work with. You learn as you go, trial by error, of course. Now, currencies can actually be traded through spot transactions, as we mentioned, forward swaps and options, where the underlying instrument is a currency at the end of the day. Currency trading occurs, as I mentioned earlier, around the world, different time zones, 24 hours a day, 5 days, five and a half days a week. The line between profitability, profitable forex trading and ending up in the red may actually be as simple as choosing the right account. So by all means, if you don't have an account, set one up with us today. So, the other thing that a lot of people want to know is who actually trades Forex. Well, the greatest volume of currency trading in the interbank market is that, you have this you have where you have a lot of banks of all sizes that trade currencies with each other, and through electronic networks. Big banks, in terms of their accounts, for a large percentage of total currency volume trades. So bank facilitates forex transactions for clients and conducts speculative trades from their own trading desks. When banks act as dealers for clients, the bid-ask spread represents the bank's profits. Speculative currency trades are actually executed to profit on a currency fluctuation. The other point is you have central banks who are extremely important players in the forex market. The open market operations and interest rate policies of the central bank actually influences currency rates to a very large extent. Central banks are also responsible for forex fixing. Now, this is the exchange rate regime by which is led by a currency which will trade in an open market. Floating, fixed, and pegged are the types of exchange rates regimes. Any action taken by a central bank in the forex market is done to stabilize or increase competitiveness of the national economy. The nation's economy, and you've got central banks as well as governments and speculators who actually may engage in currency intervention to really make their currencies appreciate or depreciate quite dramatically. You have a lot of announcements such as the FOMC where you see massive currency fluctuations, whether it's up or down. You have geopolitical announcements that come online. You have some sort of political announcement that will affect the currency one way or another. So it's important to keep your mind on this and see the sort of fundamentals that might be released around this. And during these periods of long deflationary trends, for example, central bank may weaken its own currency by creating additional supply, which is then led to which is then used to really purchase a foreign currency. So this effectively weakens the domestic currency, making exports more competitive in a global market. Now, central banks use these types of strategies to really calm inflation, but they can also provide longer-term clues for the forex traders. So another point you have is the investment managers and hedge funds. Now, after banks, portfolio managers, pooled funds, and hedge funds actually make up the second biggest collective of players in the forex market. And investment managers trade currencies for large amounts and with large accounts, such as pension funds and endowments. So an investment manager with an international portfolio will have to purchase and sell currencies to really trade foreign securities. Investment managers also may make speculative forex trades, and hedge funds actually execute speculative currency trades as well. So you also have corporation firms that are engaged in importing and exporting, conduct forex transactions to really pay for the goods and services. So consider the example of a German solar power producer that imports American components and sells final goods in China. Now, after the final sale is made, the Chinese yen must be converted back into euros, and the German's firm must actually exchange euros for dollars to actually purchase the American components. So companies trade Forex to hedge the risk associated with foreign currency translations. So the same German firm might actually purchase American dollars in the spot market or enter into a currency swap agreement to really obtain dollars in exchange of purchase of components from America or an American company in order to reduce foreign currency exposure risk. So hedging against currency risk can actually add a level of safety to your offshore investments. Now, you also have individual investors, such as yourselves and I. The volume of trades made by the retail investors is extremely low in comparison to that of banks and other financial institutions, but the Forex trade is actually growing rapidly in terms of more popularity. So retail investor-based currency trades on a combination of fundamentals, interest rates, partially inflation rates, monetary policies, and expectations, etc. So, you also look at technical factors, support and resistance, technical indicators, and price patterns. So I will go through some of this in other webinars that I will be developing, and I hope you learn some more off me. But one thing that you clearly have to understand about the Forex market participants is the trade of currencies for very different reasons. So speculative traders speculative trading is actually executed by banks and financial institutions, hedge funds, and individual investors. Are profit motivated. Central banks actually move the Forex markets dramatically through monetary policy, exchange regimes, in terms of its setting. And in rare cases, currency intervention. Now, corporations trade currencies for global business operations and to hedge their risk. The use of margin to trade in the exchange market can magnify profit opportunities, which I'll explain shortly. Forex traders should really shape businesses. So resulting collaboration of Forex traders is a highly liquid global market that actually impacts businesses around the world. So the exchange rate movements are a factor of a form of inflation, global corporate earnings, and balance of payments in terms of accounts for each country. So the popular carry trade, for instance, has its highlights on how market participants influence currency exchange rates that in turn have spillover effects on the global economy. The carry trade executed by banks, hedge funds, investment managers, and individual investors is actually designed to capture differences in yields across currencies. So in its process of borrowing low-yielding currencies and selling them at to purchase higher-yielding currencies. For example, you can look at the Japanese yen, which has a low yield, and market participants would actually sell it and purchase a higher-yield currency. So when interest rates in a higher yielding countries actually begin to fall back towards its lower yielding countries, the carry trade unwinds and investors actually sell their higher yielding investments. An unwinding of the yen carry trade may cause large Japanese financial institutions, investors with sizable foreign holdings to move money back into into Japan as the spread between foreign yields and domestic yields narrows. So this may result in a broad decrease in global equity prices. But look, the bottom line is simple. The carry trade actually highlights how the Forex players impact the global economy. And investors can actually benefit from knowing who trades Forex and why they do it. So look, the conclusion is simple, okay? You have to understand, like anything you get into, the core basics, the background, understanding how it forms, how everyone works in it, who are the main players, what their initiative is, and how they potentially manipulate the markets, who moves the markets, which I've explained to you today. Central banks do it. Central banks influence or intervene in markets at some points. You know, you've got hedge funds and banks and major institutions that actually manipulate the market in terms of the amount of money that they buy into or sell into the market, meaning that the volatility and momentum of the amount of funds that have come in will drive the market in a certain direction. So there are a number of reasons for this. But look, you know, I'm glad that we've gone through most of this, and you know, I hope to see you in some of the other webinars that I'll be conducting. But for the time being, let's do this. Let's see if anyone has any questions. I'll be happy to answer them, and then what we'll do is we'll go straight into a live trade. And again, if there are any questions, then you know, we can answer them there as well. What should you look for when you're trying to identify areas of supply and demand? Okay, well, look, as I said, you know, you have to be able to understand a certain economy, certain country, understand what makes that current country tick. What is the main backbone? I can give you a prime example right now. Nigeria's currency has gone, has really got a lot of inflation on it right now, and the main reason for that is that they can't sell their oil at the price that they're accustomed to, okay, which has devalued their currency. So in that case, okay, you know that that ticks that currency, and that's how that currency and country can be evaluated. Of course, you look at GDP, you look at a number of different factors to create an overall analysis, okay, but we'll cover a lot of those in most of the other webinars that we go through. Is it possible to become a millionaire with Forex trading? Well, look, you know, it depends how good you are and how much you learn, and you know how adaptable you are as an individual. Of course it is. I mean, look, you've got Forex trading, it's a virtual market. You look at any other market. You look at Warren Buffett. You've got prime examples there of people that understood fundamentals, understood their technical analysis, and made the most of it. But it took them a while to be able to achieve what they got and what they have today. But it took a lot of hard work. They didn't work for their money. Their money worked for themselves, i.e., they placed their money into virtual markets. They placed their money into stock markets. They placed their money into currency markets, which Warren Buffett also did. So, you know, when you have key individuals like that, then of course your question should be answered by looking at some of those examples. Will the spot trading be considered as Sharia compliant as opposed to the futures market, or is the Forex trading not Sharia compliant at all? Okay, look, you know, that's a question that I apologize if I'm going to be very frank with you, okay? But no matter whether it's Sharia compliant or not, spot markets have been operating not only in the currency market, but in every commodity market worldwide. That means if you're from an Arab, or if you're from a Persian, or the Middle East, or anywhere in the world that has some form of Sharia compliance and has raw commodities, okay, these are exchanged on a spot market basis. They're bought on a spot basis. So a spot basis means the price that the market is offering that product at that time, at that day. So of course, your question is if it's Sharia compliant. You know, I know that the UAE has some of the biggest Forex brokers and a lot of major Forex traders sitting down making money every day. I know Saudi Arabia has it. These are all Sharia compliant countries in terms of the laws. So I believe that should answer your question. Moving on, ladies and gentlemen. there aren't any overnight fees in the Forex market. You need to have the capital in your accounts to be able to have the margin in place to withstand you from actually getting a margin call. So a margin call means that if your margin drops under 100%, okay, then you're going to get called, and if you get called, that means you lose all your trades and everything you've done for that time. So you have to know your risk management. You have to know how much you're trading. Okay, you have to see what you can withstand and what you have in the account. So I'll show you when we go into MT4 platform in terms of margin and how you can actually reduce that risk. Okay, which I've already done on one trade. Hopefully it hasn't gone the opposite way, but it shouldn't, because I have covered my back. Okay, moving on, ladies and gentlemen, because we don't have that much time, and I want to at least get one trade out of the way. How do you keep track of the markets? Of the market makers? You're asking a question that essentially, if you really want to keep track of market makers, you can go to the banks. They are market makers at the end of the day. Brokerage companies have similar structures. Some are STP, some are market makers. But that doesn't affect how you trade. It doesn't affect your potential opportunity of being profitable. All right, moving on. How to place one successful trade on binary options a day. Well, look, if you follow me and you follow a lot of the webinars that I conduct, I will show you exactly how you can be profitable on the Forex market, on the stock market, on any virtual market, because the technical aspects are the same. The fundamental aspects are the same. One of the things I would say to you, ladies and gentlemen, is first, learn. Make the mistakes. Learn of someone. Find out new techniques. Find your strategy, which I will teach you all over time. It's all about creating a plan, of creating your strategy, understanding what you're buying into, and the same goes with the binary options market, okay? Except the binary options market works on a much smaller time frame, because you're buying and you're selling at a certain period of time, okay? So it works differently, but it is still based around the same technicalities of how a market or currency pair works. So if you can make money on the Forex market, then you can definitely make money on the binary options market as well. But look, ladies and gentlemen, there's always a risk involved in this industry. The platform is great. All you have to do is, of course, register and open up an account, and of course have a look at the website itself, GSI Markets, and see what there is to offer in terms of, if you're asking me about bonuses, if you're asking me about certain incentives, by all means visit the website, and you'll get to know what you need from there. There's always a recording of the webinars. You can always get them from investing.com. Just send them an email requesting for it. How to place one successful trade? I'm going to show you that now. Well, potentially, if it doesn't go the wrong way for me, and if the time frame doesn't kill it. Okay, ladies and gentlemen. Now, we have here, let's see what's happened to these trades. Okay, now, what you see here, all right, I'm going to teach you how to use one technical indicator. It's called stochastic, okay? But what we're going to do first is I'm going to explain to you what I had done on my trades before we got on this webinar. Now, you can see I have a sell position and I have a buy position, okay? The funny thing is it's gone the opposite way around now. Okay, as you can see, my buy position is not profitable, but my sell position is. But what I had done was I bought. Apologies, I get that wrong. My sell position was profitable and my buy position was not profitable. So what I had done was I sold my position based on the technical analysis that I had done with the one instrument being one indicator being stochastic. Okay, it's the red and blue lines that you're seeing on the screen. Now what I had done was I got the indication of where to buy, where to sell, which I think it was somewhere along this point, or it could have been at this point here. Okay, so with the indication that I saw, I based it on the 30-minute mark, so I believe it was around this point here. This is where I had sold my position. Okay, now what I had done was I sold my position based on a crossover, as you can see here. Okay, where you have the red, okay, crossing over the blue line and blue line dropping still. Okay, now because of the crossover, okay, this is an indication that the market price will drop. But then you also have a flip over, a reversal over here. Okay, I don't know if I can, let me see. Okay, here we go. 1 second, ladies and gentlemen. Let me get a highlighter. No, yeah. Okay, so as I was saying, you've got this point here. You've got the crossover there, okay? Now, I had actually bought into the position, sold into the position over here. Over here. Okay? So I sold on this position here, which you can see the way the market had dropped, and you can see on the candlesticks the flow that is dropping. It's dropping, it's dropping. Okay? Then I decided, since I'm already profitable here, you can see that my profit still hasn't really changed that much, even though my sell price, my sell position has actually gone up in profit, and my buy position has gone down in negative, but it's still maintained what I have in my account in terms of profit. Okay, I'm going to explain why I've done this now. So I sold here. I made $3,000 profit down here. Okay, and I saw the crossover again. So what I said to myself is, let me hedge the position. Okay, let's reduce the risk on margin. Okay, so I don't get a margin call and I lose all my capital and my gains. Let me reduce the risk and buy a position, since the market is going to start changing, and I don't know if it's going to continue to rise or if it's going to drop. Okay, so based on this, all right, I had bought the position, and the position has, again, it's because it's hedged, it's maintained a good margin for me. It's maintained the exact sort of margin that I was looking for, minusing the commissions, the spreads that the broker has taken. Okay, so I haven't lost anything by doing this trade. I've just secured a position, whereas if this reduced in profit, this would gain in profit and would maintain this balance of profit. Okay, so that I wanted to show you, ladies and gentlemen. Now that we've done that, I'm going to go back to the normal, and I'm going to close this. 3,600 is profit. Okay, so now let's look at this position. It's crossing over again here. Let's look at it at a 1 minute time frame. It's crossed over. Let's buy on this. Looks like there's not much activity on this right now, and as you can see on a 5 minute time frame, it's still going up, but I didn't look at it in a 5 minute time frame. I looked at it on a shorter period of time, which again I rushed into. Even though you have the crossover here, I did not verify the crossover on this, even though it's on borderline, and it looks like the blue line is going to cross over back the opposite way, meaning that it would have been better as a sell position. Okay, so now that we've covered, the risk of not understanding time frames, okay, and utilizing one indicator, okay, to potentially make profit on a currency pair, okay,